Investing. It's a word that evokes images of Wall Street tycoons, complex charts, and fortunes made and lost overnight. But beneath this intimidating world lies a powerful tool, accessible to everyone. Investing is simply putting your money to work, allowing it to grow over time. Imagine a seed growing into a mighty tree, bearing fruit for years. Similarly, your money can grow exponentially over time. This growth is fueled by compound interest, creating a snowball effect leading to significant wealth. Investing is not just for the wealthy. Starting small and investing consistently can be impactful. Investing is a journey, not a sprint. The earlier you start, the more time your money has to grow. Whether your goal is to retire comfortably or secure your financial future, investing can help. It's a journey requiring patience and discipline, but the rewards can be life-changing. So, let's dive in and explore the world of investing. Before embarking on any journey, it's essential to have a clear destination in mind. The same holds true for investing. Without well-defined financial goals, you're essentially sailing without a compass, susceptible to being tossed about by the unpredictable currents of the market. Start by identifying your short-term, mid-term, and long-term financial goals. Are you saving for a down payment on a house in a few years? Planning for your child's college education? Or perhaps aiming to retire comfortably in a couple of decades? Once you have a clear picture of your objectives, you can tailor your investment strategy to align with those specific timeframes and financial targets. Just as important as defining your goals is understanding your risk tolerance. This refers to your capacity for withstanding fluctuations in the value of your investments. Are you comfortable with the idea of your portfolio experiencing short-term volatility in pursuit of potentially higher long-term returns? Or do you prefer a more conservative approach, prioritizing stability and capital preservation? Your time horizon, or the length of time you plan to stay invested, also plays a crucial role in determining your risk appetite. Longer time horizons generally allow for greater risk-taking, as you have more time to recover from any market downturns. Conversely, shorter time horizons may necessitate a more cautious approach, focusing on investments that are less susceptible to market volatility. The world of investing offers a vast and sometimes overwhelming array of options, each with its own unique characteristics, risks, and potential rewards. Think of these investment options as different types of ships, each suited for a particular leg of your financial journey. Stocks, often referred to as equities, represent ownership in publicly traded companies. When you buy a stock, you're essentially buying a small piece of that company. Stocks offer the potential for high returns but also come with a higher level of risk, as their value can fluctuate significantly in the short term. Bonds, on the other hand, are like loans that you give to governments or corporations. In exchange for lending your money, you receive regular interest payments and the return of your principal at the bond's maturity date. Bonds are generally considered less risky than stocks, as they offer more predictable returns. Mutual funds and exchange-traded funds, ETFs, are like baskets of stocks or bonds, allowing you to diversify your investments across a range of assets with a single purchase. This diversification helps to mitigate risk, as the performance of any single holding has less impact on the overall portfolio. Real estate, precious metals, and commodities are other investment avenues that can provide diversification and potential inflation protection. However, these asset classes often require specialized knowledge and may come with higher transaction costs or liquidity constraints. Now that you have a basic understanding of different investment options, it's time to take the plunge and start putting your money to work. The first step is to open a brokerage account, which serves as your gateway to the financial markets. Think of a brokerage account as your ship's helm, allowing you to navigate the vast ocean of investment opportunities. There are numerous brokerage firms to choose from, each offering different features, fee structures, and investment platforms. It's essential to do your research and select a reputable brokerage that aligns with your needs and investment goals. Once your account is set up and funded, you can start buying and selling investments. Many brokerages offer online platforms that make it easy to research investments, track your portfolio, and execute trades with just a few clicks. However, it's crucial to approach investing with a long-term mindset and avoid getting caught up in the allure of quick profits or market timing. Remember, successful investing is a marathon, not a sprint, and patience and discipline are your greatest allies. Section 5. Building your fleet diversification and asset allocation. Imagine putting all your eggs in one basket. A single mishap could spell disaster. The same principle applies to investing. Diversification, or spreading your investments across different asset classes, sectors, and geographies, is crucial for mitigating risk and maximizing returns. Asset allocation refers to the strategic distribution of your investment portfolio among different asset classes, such as stocks, bonds, and real estate. The specific allocation that's right for you will depend on your risk tolerance, time horizon, and financial goals. A well-diversified portfolio is like a well-balanced fleet of ships, each designed to weather different sea conditions. By diversifying your investments, you reduce the impact of any single asset's poor performance on your overall portfolio, ensuring a smoother and more predictable journey towards your financial destination. Regularly rebalancing your portfolio is also essential for maintaining your desired asset allocation over time. As market conditions change, some assets may outperform others, causing your portfolio to drift from its target allocation. Rebalancing involves selling a portion of your overperforming assets and reinvesting the proceeds in underperforming assets to restore your original allocation strategy. Section 6. Avoiding the reefs. Common investment mistakes. Even experienced investors face rough seas. Avoid common pitfalls to navigate your financial journey confidently. Don't let emotions dictate decisions. Fear and greed lead to impulsive actions. Stick to your plan, even when markets fluctuate. Chasing past performance is misleading. Diversify to protect against market unpredictability. Conduct thorough research before investing. Section 7. A smooth voyage investing for the long haul. Investing is not a get-rich-quick scheme. It's a long-term game that requires patience, discipline, and a commitment to weathering the inevitable market storms. Just as a ship's captain must navigate choppy waters to reach his destination, so too must an investor ride out periods of market volatility to achieve his financial goals. One of the most important things to remember when investing is that time is your greatest ally. The longer you stay invested, the more time your money has to grow and compound, potentially generating significant wealth over the long term. It's also essential to avoid trying to time the market, which is notoriously difficult even for seasoned professionals. Instead, focus on building a well-diversified portfolio that aligns with your risk tolerance and financial goals, and then stick to your plan through thick and thin. Remember, investing is a journey, not a destination. There will be ups and downs along the way, but by staying focused on your long-term goals and making informed decisions based on sound investment principles, you can navigate the waters of the market with confidence and reach your financial destination. Section 8. The Open Sea. Embracing the future of finance. The world of finance is constantly evolving, with new technologies and investment opportunities emerging all the time. As you continue your investing journey, it's crucial to stay informed about these developments and adapt your strategy as needed. One of the most significant trends shaping the future of finance is the rise of fintech, or financial technology. Fintech companies are leveraging technology to create innovative investment products and services that are more accessible, affordable, and user-friendly than ever before. From robo-advisors that provide automated portfolio management to crowdfunding platforms that allow you to invest directly in startups, fintech is democratizing access to financial tools and empowering individuals to take control of their financial well-being. Another important trend to watch is the growing focus on sustainable investing, also known as ESG, environmental, social, and governance investing. ESG investors seek to align their investments with their values, supporting companies that are committed to environmental sustainability, social responsibility, and good corporate governance. Section 9. Conclusion. Charting your course to financial freedom. Investing is a journey that can lead to financial security, independence, and the realization of your dreams. By understanding the fundamentals of investing, setting clear financial goals, and developing a sound investment strategy, you can harness the power of compounding and watch your wealth grow over time. Remember, investing is not just for the wealthy or financially savvy. It's accessible to everyone, regardless of income level or investment experience. The key is to start small, invest consistently, and stay the course, even when the market throws curveballs your way. As you embark on your investing journey, remember that knowledge is power. The more you learn about investing, the better equipped you'll be to make informed decisions that align with your financial goals and risk tolerance. So, what are you waiting for? Take the first step today and chart your course to financial freedom. The open sea of investing awaits, and with it the potential for a brighter financial future.